Indian market has displayed relative resilience, at least at the superficial level. The Midcap indices have touched a new high during the last 2 months and have stayed put broadly in that range. When we drill down deep, we see some signs of stress. We pointed this out in last month's discussion that the ramifications of the Iranian crisis will flow through to the economy and to the markets. The economic impact of the crisis is solidifying and crystallizing. What the government has sought to do in recent weeks is to defer the cost and stagger the pain. The market, at least in pockets, has taken this view that this too shall pass without any lasting impact. It is true that the market has taken a lot of negative news in its stride over the last couple of years. Normally, the view would have been that this crisis is already in the price, but the lessons do not seem to have gone down well in the market. To our mind, the small and mid-cap valuations remain unsustainably high and they refuse to adjust. Persistent domestic buying is behind this, and this is being seen as a sign of investor maturity in India and resilience of retail flows. In some narratives, we have also come across this being referred to as a performance asset for India as an investment destination, and this is a very dangerous track to get into. FIIs have been dismissed as volatile actors. The fact remains that FIIs have been invested in India for over 30 years, and for much of that period they have been constructive on Indian equities. INR depreciation is being seen as a much needed adjustment. The reality is somewhat different. The current account deficit has been persistent in India and always needed to be bridged with capital flows. Debt capital flows are hard to come by in the current context. The interest rate differential offered by the Indian bonds is not so attractive at this point in time. If DI flows have been indifferent and FIIs have been persistent sellers, it is against this backdrop that we have to view the currency depreciation. What the INR depreciation has done is to deal a body blow to capital stock, value of capital stock in the country, held both by foreign investors and by Indian households. For foreign investors, this represents a brutal haircut of about 20% in less than 2 years, depending on what currency we are looking at. Equally importantly, for the Indian households, this represents an irreparable damage to their purchasing power of savings. So, in our mind, asymmetric risks have been building up in the market. The market has been bumbling along near the edge of a precipice, and this is not a comfortable situation we see emerging over the last 2 months. The administrative handling of the crisis has been exemplary. In the immediate aftermath of the Iran crisis, the government managed to avoid shortages, and this has helped the economy over the last 3 months. In recent days, the government has sought to defray the cost and defer the pain. What this means for the economy is that the pain is ahead of us and not behind. Inflation is definitely likely to go up. WPI went up steeply in the month of April, and we see this seeping through to CPI in the coming months. There is a realistic probability that inflation will translate to wage price inflation, which will not look pretty for producers. There is very little wiggle room for RBI or for the government in terms of policy action. Both the government and the RBI have exhausted most of the bullets in trying to stimulate the economy in FY25 and FY26. In terms of earnings growth, the expectations of mid-teen earnings growth for FY27, which was prevailing some months back, has now been marked down to about 12%. Judging by what is happening on the ground and commentary from managements in recent days, we see impact beginning to be felt at the corporate level. and it's quite likely that earnings would get downgraded to mid-single digits as against the mid-teen expectations as time goes forward. In the meantime, the economy has developed some cracks that are not easily visible at the surface. The K-shaped recovery in the economy during the post-COVID times has left the bottom half of the income pyramid very vulnerable. The household debt has increased, and by broad measures of household liabilities stands at about 42% of GDP, which is a big increase over what was prevailing at the time of COVID. The stress on the macro and the squeeze on household budgets due to adjustments to cost of living may seep through to demand. So what essentially started as a supply side crisis may translate into a demand problem for the economy. Therefore, what we assess is that for both market and the economy, the pain or some bit of pain is ahead of us and not behind. Forecasting is fraught with uncertainty, particularly in these difficult times. We need to understand what can affect our cautious outlook on the economy and the markets. First of all, if the Iranian crisis is resolved to the satisfaction of all parties in pretty quick time, and oil prices settle below $80 per barrel, that would be a big breather for Indian macros. If Indian small and mid caps deliver against all odds, against the correlation with macro stress, against rising inflation and surmounting raw material pressures, and they deliver healthy earnings growth, that would be a positive surprise. If FIIs pivot and buy on the premise that the selling that they have done is just country rotation so far, that would be a big relief for Indian balance of payment situation. If Indian households, the demand from Indian households remain resilient despite the mounting macro pressure and stress on household budgets, and tax revenues remain buoyant, that would be a positive for the Indian economy. However, we feel that the probability of these happening, particularly in tandem, is rather low. We need to understand some facts first. The FII selling does not appear to be the exit of hot money. About 12 lakh crores of FII selling has been witnessed in cash equities after 2021, and that doesn't look like hot money going out. It's not routine profit taking. It's not country weight adjustment. There may have been an element of country weight adjustment that happened in 2024 when India's weight in MSCI emerging market index went beyond 20% and at some point exceeded that of China. The MSCI India weight has since dropped down to 11%, and the selling continues. To our mind, it appears that FIIs have been patient sellers in India, and this is something that has been underappreciated in the domestic discourse. So we need to understand what is behind this. The valuations in India have been unsustainably high, and this is a view which the FIIs would have taken. And the valuation premia cannot be taken as permanent. We need to look at the nature of Indian growth and the nature of Indian corporate earnings growth. The Indian GDP growth has a secular element to it, which we believe is about 5 to 6% of GDP growth. That is largely secular and sustainable. The delta over that is something that is proving to be very cyclical. This is reflected in the corporate profit growth. Indian corporate earnings growth is not underpinned on any IP or on technology moats. It's largely driven by government capex spending and through high decibel consumption. And we have seen that these are vulnerable to macro shocks. And therefore, it is fair that FIIs have taken a considered view of the situation. Further on, the K-shaped recovery in India has started to peter off, and this puts some stress on the notion of secular growth in disposable income. In the meanwhile, the welfare spending as a percentage of GDP has been on the rise. Welfare spending as a percentage of state GDP has risen steeply since COVID, and together with the central government spending on welfare, India threatens to become an unsustainable welfare state, and this could crowd out government capital spending. We see that the private capex spend is a no-show, and the paradox in all this is brought out by this fact. Therefore, to our mind, it appears that FIIs have taken a decision that a mean reversion in valuation, a meaningful mean reversion in valuation, not just to the 3 or 5 year mean, is a distinct possibility. This is perhaps well supported by their institutional memory and experience in several markets over the last many decades. What makes this situation particularly difficult in the current context is India's balance of payments crisis. The Indian current account deficit stood at 1.6% of GDP in FY26. It was under 1% in FY25, and it threatens to deteriorate to about 2.5% to 3% in the coming year. In 2013, by contrast, current account deficit was at 5% of GDP, and that was when we saw the last big bout of currency depreciation. However, this time the current account deficit is not so bad, yet the currency has depreciated both against the euro and against the US dollar, and very steeply. Why is this happening? The obvious answer is to do with capital flows. But whereas the high Indian valuations have been referred to, the fact that this could be a central reason has not been emphasized enough. India cannot outgrow the current account deficit through exports, whereas free trade agreements and PLI schemes can help sustain export growth in the medium to long run. We need capital flows in the short run. So therefore, it is in this context that FIIs have viewed the buying in Indian equities by domestic investors. This looks increasingly like a wealth transfer from middle-class Indian household to foreign investors, and as long as domestic investors are willing buyers of expensive Indian stock from foreign investors, this selling could very well continue. We've come across this observation that since the SIP flow from Indian households is funded by non-leveraged source of funding, this can sustain indefinitely into future. There is also this assertion that valuation lies in the eyes of the beholder, and what may look expensive to some can look reasonable to others, particularly if they telescope well into the future, and which is what the households in India are said to be doing. We examine this premise on the basis of data, both on historic parallels elsewhere and the internals of the SIP data. History is not very supportive of this argument. India lacks precedence in this respect. The Indian SIP phenomenon is relatively recent. This has seen a very rapid acceleration in the post-COVID times. There are interesting parallels from Japan and the US. In Japan, there was no SIP, but household finances or household savings was channeled into the equity markets in the 1980s through the post office system and through insurance, and households kept buying very expensive Japanese stock. and they lost a lot of money when the market crashed in the late 1980s. It's pertinent to note that foreign investors were sellers in Japanese equities in the preceding period. The US is another interesting example. Here, the middle class savings in the US was channeled into equities through the 401k route, and during that period, the valuations expanded from low double digits to somewhere mid-20s in terms of PE in a matter of 20 years from the 1980s. But there are very sharp differences to the US context. The US interest rates during the same period fell from somewhere around 15-16% to 5%. The US saw a massive boost to productivity when it grew in the 1990s. This was led by technology innovations as well as improvements in healthcare. The US started this journey as a wealthy economy. India is still a very poor country, and the US valuations did not go to 50, 60, 70 times. Therefore, we believe that the comparison with the US does not hold good. So our assessment based on this is that the valuation premia can only sustain if earnings growth is high, persistently secular, and is of good quality. These do not appear to be the case in India at this point in time, and therefore we are skeptical that this argument holds good. We also took a look at the SIP data. AMFI puts out a lot of details on the SIP flows. What they don't put out is the state of household finances for the people who invest into SIPs. It's not their mandate to do so, and they have no incentive to give this data. RBI, however, gives data on the state of finances of Indian households and how this has moved in the last several years. The SIP data itself shows that out of rupees 29,000 crores of gross SIP flows that we have seen in recent months, this comes from about 9 crore investors, translating to a unit contribution of about 3,200 a month. There is a skew in the contribution in the sense that a smaller number of investors contribute a relatively larger part of the SIPs. So it's reasonable to assume that majority of these 9 crore investors make unit contributions between about 1,000 to 2,500 rupees a month. When we look at the household financial stress, this has worsened materially from about 32% debt to income to about 42%, a 10% deterioration which we have seen in roughly the last 10 years, beginning the demonetization year and then accelerating well post-COVID. Now, it stands to reason that there is an overlap between the households that have leverage and the households that are contributing to SIP. And when we look further into the data, it once again comes out that the EMI burden of households having debt should be many times the SIP monthly contribution. This data could be interpreted to state that the SIP contribution may continue as this is a relatively smaller part of the household budget. However, data does not support this. The SIP stoppage ratio has been rather high, and even adjusted for certain one-offs in recent months, the SIP stoppage ratio is very high. And therefore, this seems to indicate that the households are responding to the stress that is seen on the balance sheet, the fact that the 1, 2, 3 year returns from SIPs has been low or even negative, and now there is stress on household budgets due to cost of living increases as well as some level of income uncertainty. Therefore, we believe that expectations on SIP bailing out high Indian valuations look rather preposterous at this point in time.